So we have the US market basically at a record high. It looks like we could get a slightly soft open this morning. Our guest says, looking at equities, this appears to be the best market set up in 30 years. And he thinks it's a generational opportunity to create massive wealth. And he has some stock picks for you. Eddie Ghabour joins us now, CEO at Key Advisors Wealth Management. Eddie, great to see you. You think it's a time to get into the stock market?
I really do. We've been saying this really since April when we started aggressively buying the dip. And now the missing piece that the bulls needed to really take this to the next leg up over the next 6 to 12 months was a Federal Reserve that was going to turn more dovish and start cutting interest rates. And we finally got that. And so whether they cut 2 times this year or 3 times this year, I think what investors need to do is take a step back and take a look at the whole environment in the sense that the trend is going to be interest rates going down with an economy that is going to be reaccelerating over the next 6 to 12 months. And it's very rare to see that scenario because normally when a Fed is cutting interest rates, they're cutting interest rates because an economy is in a recession and needs stimulus to get back to life. Well, we have stimulus coming at a time when one could argue the economy doesn't necessarily need it. But at the end of the day, that's almost as bullish as it gets, in our opinion, for risk assets. And we're going to have volatility, but dips are going to be aggressively bought because so many people continue to doubt this and they've underperformed.
What about small cap stocks? We've got the Russell 2000 index trading near record highs.
So we believe small caps will continue to outperform. It's been since 2021, since the IWM, which is an ETF that we use for clients, has gotten to the level that it's been in. So it's been an underperformer for a while now. And now with interest rate cycles going down, with an economy that we believe will be reaccelerating, we think small caps will continue to outperform. And it's an area that we're going to be looking to buy dips on and continue to increase our exposure there as this market broadens out.
It's fascinating, isn't it? What could go wrong, though, Eddie? Obviously, a surge in inflation would tend to delay or even reverse the interest rate cuts.
The biggest thing that could go wrong is just checking the 10-year bond. Right now the 10-year bond is tame. It's well under 4.5%. But as the 10-year bond ultimately gets back up, and it will at some point in time because inflation is going to reaccelerate. You can't have asset prices go through the roof like this without expecting inflation to go up. But as long as the 10-year bond stays below that 4.5 level, it is a risk-on environment. Once it breaks that and goes to the 4.7 level and then the 5, that's when this bull market run will end and you have to be prepared to sell. But that's not anything we're worried about here in the near term. The last leg of a bull run can be the most lucrative leg, and that's the leg that we believe we are in right now heading into 2026.
One stock you reckon is a top AI play is Tesla. Tell us why you're bullish on this name.
So this name, again, has been a big underperformer. And what we've been doing is rotating into areas that have underperformed that we think will have what we call a catch-up trade. Tesla, I believe, you had 2 things working against it. Elon being more involved in the government, which now he's not. He's fully focused on his businesses. And then secondly is comparing them to autos. This is an AI play, and I believe that there's no one that's going to be more aggressive in leading the AI race than Elon Musk. And whether you love him or hate him, you have to respect what he's been able to do, and that stock, in our opinion, has a tremendous amount of upside if you've got the right risk tolerance over the next 6 months.
Amazon, a play on, well, what in particular? Is it the cloud that you like, their AI prospects?
AWS was a reason why that name got beat up after the last quarter, and you're slowly starting to see Amazon trend upwards. We believe AWS earnings will surprise to the upside in this next quarter, but it's also a play on the consumer. There have been some cracks in the labor market, but at the end of the day, the consumer's been extremely resilient, and we believe that we are heading into an environment where the economy will accelerate. So these consumer discretionary names are an area that we continue to increase our exposure to, because that's where we think the outperformance will be, along with the small caps and other areas we've discussed.
And what about Bitcoin? You think broadly this is a good environment for Bitcoin?
Bitcoin is the ultimate, risk-on trade, right? And because of our market thesis that we're going higher, we would look at today for the person with the right risk tolerance as a buying opportunity to gross up Bitcoin. It will be one of the first areas we sell for clients when we believe we're at a market top. But in a risk-on environment, crypto generally does really well. And as you said earlier, it's 10% below its high, and we haven't seen that in a while. So it's a good time for us, for our clients, to increase risk there as well.
And United Health, this one's been beaten up. You do see a comeback there?
I do, and we're looking for areas outside of technology. And with the broadening out of this market because of the economy not going into a recession, we're looking at this as a large cap healthcare play that can help diversify us outside of tech. It's been beaten up, and we think that there could be quite a bit of upside here as the worst of the news for this company, in our opinion, is behind it.
And finally, JP Morgan, you and a lot of portfolio managers think if you're going to own a bank, this is the one to put in your portfolio.
It is. This is a bet on the CEO. Jamie Dimon, in our opinion, is one of the best CEOs on the planet, and this makes us a great large cap play in an area and sector that has a tendency to do well when the Fed is in a cutting interest rate environment. And again, it's a name outside of technology that you can broaden out. So financials, we expect to really start to, again, outperform the S&P as we head into 2026. So we would take any dips that we will get over the next few weeks as opportunities to gross up all these exposures that we've discussed today.
Thank you very much, and have a great week. Really appreciate your kicking off the week for us. Eddie Ghabour.
Thank you for having me.
CEO of Key Advisors Wealth Management.